Hey guys, is it better to buy a property or take that money and invest it in a real estate investment trust or REIT instead? This is something that I've wondered about a lot, and I know that many of you have been thinking about it too. Since this channel is all things related to personal finance, I want to take a deeper look at this. And if this is a topic that interests you, make sure you subscribe to the channel. Having real estate as part of your overall portfolio could be a good idea. But the question is, what's the best way to do this? First off, what is a REIT? Well, a REIT, or real estate investment trust, is like a stock that you can buy, and it's comprised of different properties that generate income. You can usually buy these stocks on the stock exchange, just like buying Apple or Google stocks. Now, usually these REITs have a particular focus, like warehousing or office space or shopping malls. And so when you invest in that REIT, you get exposure to the basket of properties that the REIT owns. So the REIT will receive rental income from the properties that they own, and they'll pay expenses. And of the amount that's left, they usually distribute around 80 to 90% of that back to the investors in the form of a dividend. Okay, so now that we're clear on what a REIT is, you may be wondering, what are the pros and cons of investing in a REIT? When you invest even just $100 in a REIT, you get exposure to all of the properties that that REIT owns. So maybe you own a tiny portion of some office space in downtown. And if there's a problem with one of those properties, you're not really directly affected because there's still many other properties that the REIT owns that can help absorb that loss. Imagine the REIT owns 50 properties and one of the tenants are not paying, while you still have 49 other tenants paying, and that will help cover some of that loss. It's the concept of not putting all of your eggs in one basket, and this reduces your investment risk. But compare that to a case where you invest in residential real estate. Maybe you buy a 3-bedroom house that you rent out. If you struggle to find a tenant, or if your existing tenant struggles to pay you, then you feel it very directly because you'll lose 100% of your income, and you don't have another 49 properties, for example, to help offset that loss. Now, yes, over time you can build up your property portfolio to enjoy some of that diversification benefit, but this takes a bit of time and some financial resources. Guys, you don't need to be a property expert to invest in a REIT. You have a manager of that REIT that will identify deals, that will do all of the analysis, and that will do all the due diligence needed for that deal. These guys are experts doing it full time so that you don't have to worry about all the technical details. But I have one caveat with this, and that is that not all REITs are equal. Depending on the type of properties that that REIT invests in, can really have a big impact on your investment returns. Let me give you an example. Let's say you took a lot of your money and you invested it into a REIT that focuses on shopping malls in around February 2020, just before the pandemic hit. Well, since the pandemic hit, there's been lockdowns all over the world and people's movements have been severely restricted. And this has meant that a lot of shopping malls have been ghost towns. This can mean that many of the tenants in those shopping malls are struggling to pay their rent because they're not able to generate any income from their trading, and this can lead to higher vacancies as well. And it's quite common for these types of leases to have two components to them. Number one is a fixed component, just a monthly rent that you pay every month, just like renting an apartment. But number two is a variable component, and this is determined depending on the revenue of your tenant. The more revenue they make, the higher the rent is that they pay, and this is often called turnover rental. So with the impact of the lockdowns and the shopping malls being so empty, the tenants are not generating any revenue, and as a result, their rent payable to the landlord, which in this case is the REIT, will be much lower. So I would suggest checking what type of properties that REIT is investing in before you make your investment. Now, I mentioned earlier that investing in a REIT is really simple, just like buying a stock. You can log into your trading platform, find the REIT that you want to invest in and buy it with a click of a button. It's quick and easy. And after you've made your investment, you can almost forget about it. Any repair works like a leaky toilet or a difficult tenant, you don't have to worry about it because the REIT will take care of it, and you just need to worry about cashing in your dividend check. Just like buying a stock, you can get started with a small investment. It can be just a few $100s or even less. You don't need to have tens of thousands or hundreds of thousands of dollars to invest in a REIT, and this makes it more accessible to more people. Well, I mentioned earlier that a REIT will focus on investing in properties that generate an income, with the aim of taking that income and distributing it back to the investors in the form of a dividend. And this means that they keep a pretty small portion of the pie for future expansion and acquisitions of more properties. And this often means that the capital growth of the REIT can be a bit lower than you may think. If you're not investing in growth and expansion, then you're less likely to see more growth and expansion in the future. So what ends up happening is that your dividend that you get ends up making up a pretty big portion of your total return, because the capital growth may be a bit more limited than what you would expect when compared to other investments. But this doesn't mean that the stock price of a REIT does not fluctuate. It's traded all the time, and it's affected by things happening in the economy, especially interest rates. But it's good for you to be aware of this. Okay, so we spoke earlier about the hands-off approach when it comes to investing in a REIT, and now this can be really convenient. But there also has a bit of a downside, because you have less control over your investment. You can't just go into the property and knock down some walls and repaint the rooms, maybe add an extra room or add a loft on top of the garage so that you can rent that out, all of which will increase the value of that property. Look, every country has its own tax laws, so you need to check the specifics of your country. But broadly speaking, you're taxed on the income that you earn. And the income or dividend that you get from a REIT will be taxed at your individual tax rate, much like getting a salary is. And for most people, because of the tax classification, it would mean that it's at their highest marginal tax rate. And there are no special tax deductions that you can use on that dividend that you get from a REIT to lower your tax bill. Okay, so next up, we're going to look at investing in residential real estate. And if you're enjoying this video, make sure you hit the like button. I know it seems really small, but it gives the channel a big boost and gives the video more visibility. Okay, so what are some of the cons of investing in residential real estate? Because real estate prices are so high compared to making another investment, it means that the barriers of entry are pretty high. For most people, they're going to need a mortgage to buy a property. And even coming up with a down payment or deposit can be a challenge. Imagine you're buying a property for $200,000 and you need to give a 20% down payment or deposit. That's $40,000, and that's still a lot of money. And even if you have that money, it doesn't automatically mean that you'll get a mortgage, because you'll submit your application to the bank, but they'll look at your credit score and your salary and how much the down payment is, and maybe some other debts that you have. And all of this means that the barriers of entry into the real estate market can be quite high, and it makes it not accessible to everybody. If you want to make an investment in a REIT, you'll pay a small commission, just a few dollars, like you're buying a stock. So is it the same when it comes to buying a property? No, not quite. There are many more fees that you need to consider. There will be agent commissions, there will be some legal fees, there will be some clearance certificates or inspections that you need to pay for. All of these costs will add up really quickly. But in general, I see around 3 to 6% of the purchase price, and that can really be quite a lot of money as well. Let me give you a real life example. When I invested in a property in the US of around $230,000, the total transfer costs for that investment was $6,850. So that's way more than the few dollars that you would pay in commission to invest in a REIT instead. This may be one of the big cons that people expect to encounter when investing in real estate. We've all heard the horror stories of a bad tenant that destroys a property or doesn't pay their rent. And I'm not going to lie, I've had my fair share of bad experiences too with tenants. I've told the story before where mysteriously a brick was thrown through the windows of one of our properties. And I'm not going to lie, this can add a bit of stress. But I found that if you have a good agent that can manage that property for you, that's money well spent, and it can create more of a hands-off investment for you. You need some cash quickly? Well, if you're invested in a REIT, you can just log into your trading platform, hit the sell button, and you convert that investment into cash pretty quickly. It's quick and easy. But with a property, there's so much more to that process. You're going to need to find an agent, advertise, arrange some viewings for potential buyers. Then you'll maybe get some offers and you're going to need to negotiate with these buyers. Maybe after that, they might need to apply for a mortgage, which may or may not be successful. And after all of that, you'll still need to wait a couple of weeks for the transfer to be registered legally from the seller to the buyer. So selling a property can be a much more drawn out process compared to a REIT. And I'm curious, in your experience, what's been the quickest that you've been able to sell a property and convert it into cash? Let me know in the comment section down below. Maybe also mention the country that the property was in. It could be interesting to see how this varies from one country to another. Plumbing issues, a leaky roof, broken window from a brick, these costs can pop up and they're the responsibility of the owner to fix them. And they can be pretty random and unexpected. From my experience, if you do periodic inspections of the property and deal with any signs of potential problems quickly, this can be a great preventative measure to avoid any of these big unexpected bills down the road. If you guys have watched some of my videos in the past of why I like investing in real estate, you'll know that one of the big reasons is because of leverage. The ability to use the bank's money to make that investment. I consider this to be a big benefit because it gives you the possibility to generate much higher returns. I have included a link in the description to this video where I talk more about leverage and give some practical examples, so that could be a good one for you to check out afterwards. Now earlier I mentioned that a REIT is not so great from a tax perspective, and here maybe a residential real estate investment has a bit of an advantage. Yes, you will be taxed on the rental income you generate from that property, but in most countries you can also deduct all of the expenses that you incur. So for example, any repairs and maintenance costs, the commission that you pay to the agent for managing that property, maybe some levies or condo fees, or the interest on your mortgage, all of these costs can be deducted from your tax return, which will lower the amount of tax that you need to pay. In fact, some countries go even further. For example, in the US, you can also depreciate the value of the building over 27.5 years. So if the building is worth $275,000, well, you can depreciate an extra $10,000 each year in your tax return. And finally, when you sell that property, if you've held it for long enough, the profit from that sale will be taxed at the lower capital gains tax rate. So overall, the tax impact is probably more favorable when you invest in residential real estate compared to investing in a REIT. But yes, you probably need to check with a tax advisor in your country because it depends on the local tax laws. Now, I mentioned earlier that you can probably generate higher capital growth from a residential real estate investment. And this actually brings an extra benefit with it. And that is that that property can become a source of funding. Maybe the value of the property that you bought has increased a lot. Well, this could bring the opportunity to refinance that property and access some of that growth and use it for your next investment. So I've mentioned all of these cons of investing in residential real estate. Does that mean that I prefer REITs instead? Well, actually no. My preference has always been to go for physical real estate. I've just found that you're able to generate much higher returns. Yes, it can be more expensive, and yes, it requires much more work compared to a REIT, but I think the upside is really worth it. Now, I know that some people will say, well, looking at some historic trends, that the REITs have performed better than real estate. But I don't think that this is a fair comparison because it doesn't take everything into account. Usually these comparisons only look at how much did the value of a house prices increase over a certain period of time. But that's just one component of your return, right? What about the tax benefits that I mentioned earlier, or the rental income that you've generated from that property? Those are not captured in those comparisons, so it's good for you to just be aware of that. So what do you think? Is it better to invest in a REIT or to go out and buy a property? Which have you done in the past? Let me know in the comment section down below. Also, you can follow me and Nana on Instagram, and here is my handle. And that's it for the video today, guys. I hope you found it useful, and if you did, make sure you hit the subscribe button and give it the thumbs up. I'll see you next week.